forward and take a seat because we're going to have an interesting talk. So if I could ask everybody now to please take your seats for our afternoon presentation. And I would like to introduce to you a gentleman who has spoken at several other of our conferences. Ronald Peter Stöferle is the managing partner and investment manager of Incrementum AG, where he is based out of Vienna. And together with his partner, he co-manages a global macro fund, which is based on the principles of the Austrian School of Economics. And Ronnie is also very well known now because every year he produces a benchmark report called In Gold We Trust, and he has really marked a name for himself globally now in the gold sector as a person, as an individual who has his finger on the pulse of the macroeconomic picture for gold, and is also just very interesting to listen to. So I'm going to stop talking and let you enjoy Ronald Peter Stöferle. Thank you.
Thank you very much, Jessica. It seems I'm the last hurdle between you and the drinks. For the next 2.5 hours, I'm going to present my macro view. Now, there are people here hearing this presentation for the third time in 3 days, Mr. Paul Burton. So I think it's worthwhile. We're going to make it very entertaining, and I've got a few, from my point of view, very interesting points that I want to make regarding gold. Yes. The presentation is called In Gold We Trust, or Why We Might Be Expecting Too Much from Gold at the moment. But I want to start with some lessons that life has taught me so far. I'm only 37 years old now, but I've got 3 little kids, so I got 4 women at home. I'm kind of used to suffering, used to stress, used to hard times. So one experience that I've made is life is all about timing. Everybody's talking about Bitcoin. And this gentleman, Mr. Greg Schön, he tweeted on 17th of May 2011, "I wish I had kept my 1,700 Bitcoin at 6 cents instead of selling them at 30 cents. Now they're at $8. I don't know if you follow Bitcoin. Bitcoin at the moment, it's trading at roughly $8,000. So Mr. Schön would have $12 million now. Instead, because of his poor timing, he made only $500. But I shouldn't make jokes about Mr. Schön because I sold a stock called Novo Resources, which is the hot stock at the moment, at 150, and now I think it's trading at 7. But what I wanted to tell you is the timing for the mining sector, and especially for mining stocks from my point of view, is excellent at the moment. And I'm gonna present my case why the timing might be so good. And the second thing is, the second lesson from life is that life is all about expectations and managing expectations. So how I think I look while driving is often different to how I actually look. And now probably the gentlemen here are waking up. The expectation is often different from reality. And my favorite one, be careful if you should be considering getting a tattoo. But the important thing is the expectations regarding gold, from my point of view, are too high at the moment. Adrian Day, an analyst that I highly respect, he said in an interview, people are expecting too much from gold at the moment. Why? We should not forget stocks are rallying from all-time high to all-time high. The S&P has made, I think, 53 all-time highs this year without any volatility. We're seeing the VIX at the lowest level ever. Real estate all over the world is doing extremely well. Bonds are trading close to all-time highs. Over here in Europe, we've got junk bonds having lower yields than US 10-year treasuries. The trust in the financial system and in banks and even in politicians is kind of back. We've got very low price inflation. The Fed is raising rates probably for a third time in December this year, and they're implementing quantitative tightening. I said recently quantitative tightening will be a really big word in history books because I think it's going to fail. So we bought the internet domain quantitativetightening.com. Perhaps it's a good investment, I don't know. But I think QT will be a big mistake. And cryptocurrencies are stealing the show. When I talk to journalists, I say, I'm pretty confident regarding gold. So we don't want to write about gold at the moment. Our readers don't care about gold. But if you've got a good story on Bitcoin or Ethereum or Dash or whatever, just let us know and you will be in the headlines. And I've seen 2 days ago one very interesting number. The Google searches for buy Bitcoin now exceed the Google searches for buy gold. So people are really interested in Bitcoin, in the cryptocurrency space, and I think it's kind of stealing the show from gold, even though, from my point of view, Bitcoin and the cryptocurrency space, it's very interesting, and from a philosophical point of view, I really appreciate this development because people start discussing money again. They discuss, is Bitcoin better money than gold or than the euro? Is it even money? What's the criteria that good money, solid money has to have? So I think from an intellectual point of view, it's a very good and worthwhile discussion. So at the moment, there's quite a lot of headwinds. We're in a Goldilocks scenario. We've got low price inflation. The markets are rallying. So nobody really needs gold. But still, gold is up 10% since the beginning of the year. So what's the macro picture? Warren Buffett said, a bull market is like sex. It feels best just before it ends. Now, we shouldn't think about Warren Buffett having sex. I think that's kind of an awkward thought. But of course, he's one of the most brilliant investors, so I absolutely read everything that he writes, and he's totally right with his saying. While where does all the confidence and the complacency in markets come from? We're seeing here the balance sheet of the biggest central banks. So People's Bank of China, Swiss National Bank, Bank of Japan, ECB, Federal Reserve, and we're seeing the price of gold. And you can see that, of course, the central bank balance sheets, the combined balance sheet, it tripled since 2008. We all know that. And there was a pretty positive correlation with the price of gold, but this broke down, it decoupled. So what are the reasons for that decoupling? From my point of view, is that the monetary inflation mostly spilled into financial markets, mostly into the equity and into the bond markets. But just to put the numbers into perspective, in the first quarter of 2017, only one quarter, the biggest central banks printed $1 trillion US, so 1,000 billion US dollars. What could you buy with that amount of money that is printed out of thin air? You could buy in Switzerland, which has, according to the Big Mac index, which measures purchasing power parity, you could buy 20 Big Macs for every human being, for almost 8 billion people. Or you could also buy for every human being on the planet 1/10 of an ounce of gold, so 1 Ducat coin. I would definitely recommend the latter. But just to show you the perspective, it's a massive monetary experiment that we've never been in before. Now, as I've said, this monetary inflation leads to asset price inflation. And as you might have heard, I'm got kind of a weird accent. I'm from Austria, and I'm a keen follower of the so-called Austrian School of Economics that is not popular at all in Austria, unfortunately. So the Austrian School of Economics has a different view on inflation. From the Austrian point of view, inflation doesn't mean rising prices. That's only an effect, a symptom of monetary inflation. So first of all, there's monetary inflation, and this monetary inflation created by central banks and the commercial banking system, this leads to asset price inflation, and finally, as Murray Rothbard showed, to consumer price inflation. This is the last stage. Now, we're in the middle stage. We have seen the dot-com bubble. You remember those times. We have seen the housing bubble. But during those two bubbles, other asset classes were actually not that expensive. So in the dot-com bubble, industrial stocks, for example, were pretty fairly valued. There was no irrational exuberance, as Alan Greenspan famously said. In the housing bubble, the rest of the markets was not that expensive either. But now, in this everything bubble, we've got stocks trading at all-time highs. We've got bonds trading at all-time highs. We've got the real estate market trading at all-time highs. And of course, this is fueled by debt. So in 2008, 2009, emerging markets, for example, had extremely low debt levels. What happened since then? They basically now got the same levels of debt like we have. So we're in what we call the bull market in everything. And this leads to complacency. So on CNBC, for example, which is from my point of view a very good contrary indicator, they say the best move, just buy everything. It's a very good investment advice. Yeah, you don't need a CFA or a Harvard MBA. Just buy everything. It's going to rise anyway. Well, according to Deutsche Bank, we're at the by far highest valuation level, at least since 1800. So they are calculating an index for the 15 biggest developed markets, average bond, nominal yields, and equity percentile valuations. And we're at the highest level since 1800. Now, of course, this is also the inverse of the rates chart. We have seen the Bank of England put out research last year showing that we're having the lowest interest rates in the last 5,000 years. So I'm not sure about those numbers, how you can calculate them 4,000 years ago. I don't know what they had. But of course, we're having extremely low rates. So this is, of course, the inverse from such a valuation chart. But what I want to tell you is, the higher those valuations are, the more sensitive the whole system becomes to rising rates. And I've just recently been to a very high-level conference in Switzerland, only institutional players, and I had really interesting discussions, especially after the official part of the conference. You know, you're having a couple of beers and then you talk to the asset managers, and they were mostly pension fund managers, and they said, you know, we know valuation levels are extremely high. We know it, but we just have to be at the party, we just have to dance, but we will get out of the market before it crashes. Now, sounds interesting, but normally it just doesn't work that way. And then on the next day I went running, and then a stupid picture came to my mind. I've seen it at the so-called Darwin Awards. The Darwin Awards, they nominate people that basically shoot them out of the gene pool through kind of weird actions. And you can see a couple of guys drinking beer, and then one guy saying, well, let's have a barbecue. And the other guy said, that's a brilliant idea, excellent idea. So they get this electrical barbecue, and then they've got this extension line, and then they've got those flip-flops that float. And, well, you can do it that way. But life has also taught me there are moments when you should kind of reconsider your actions, when you say, that's not a good idea. And there are also other examples. It's not a good idea. Perhaps I should reconsider what I'm currently doing. And this is actually the winner of last year's Darwin Awards. So, I think the recommendation just by everything at those market valuations, it's kind of dangerous. Now, let's get back to gold. What we can see here is quite a lot of numbers. So I'm basically showing gold in different currencies, US dollar, Australian dollar, Canadian dollar, and so on. And for me, that's really important in my analysis. We crunched the numbers and we found out that if you want to have a strong bull market in gold, it should basically be rising in all currencies. So what we are also calculating is the world gold price. So not gold only measured in US dollars, but in a world currency basket. And as I've said before, despite all those headwinds that we're having, gold is up 10% in dollar terms year to date. Gold was up 9% in dollar terms last year. It's up in basically every currency but the euro. But in euro terms, it was also up 12%. In British pound terms, it was up 30% last year. So actually gold is doing extremely well. But still people think, gold is kind of dead. So for me, that's a very, very good sign that we're in the early stage of a new bull market. The Dow theory, created by Charles Dow, it basically says in every big trend there are three stages. First, there's the accumulation phase, when contrarian investors buy, when the media sentiment is extremely negative. I think we have this accumulation phase basically end of 2015, beginning of 2016. The second stage is the public participation phase, when the trend picks up, when the media is becoming more interested, when the whole wealth management industry, private banking and so on, they jump on the train. And nowadays, no private banker would basically say, you should own some gold. But I know that at 14 or 1500, they're all gonna say, we always said, you have to own some gold, at least 10 to 15%. Just remember 2011, the analyst forecast on Bloomberg was extremely positive. It was actually 30% above the current price. At the moment, analysts, questioned by Bloomberg, they see gold basically flat the next 3 years. So there's no confidence in gold. But as soon as prices rise, this confidence is kicking in. And of course, the last stage of this Dow theory is the so-called distribution phase. And this is the phase when the media gets really excited. You're reading gold $10,000 on tabloids or whatever, and when basically everybody is interested in gold. And this is also the phase where those smart investors that bought into very early, that they're distributing their holdings. Now, let's have a look at the opportunity costs. So what I'm doing here is I'm calculating a ratio. So basically, a falling ratio means that stocks are showing relative strength to gold. We can see that since 2012, we've seen massive relative weakness. So the stock market was outperforming gold. But since 2015, 16, there's basically some sort of base building. So we don't see that much relative strength of stocks anymore. And what we're calculating here is a 200-day moving average. And at the moment, it seems that we're above this average again. So it seems that this relative weakness of gold versus the stock market is kind of coming to an end. And of course, there's a very high correlation between gold and the commodity sector. So what we're doing here is we're calculating a index total return versus the S&P. So on a relative basis, commodities are extremely cheap compared to the stock market. And normally, this is what life and markets taught me, there's mean reversion happening in markets. So we're now at a ratio of 1. the median is at 4.1. So normally it should at least mean revert, meaning commodities should massively outperform the S&P. Now, those headwinds that we are facing at the moment, sooner or later, they will become tailwinds. And from my point of view, the most important drivers are recession risks and inflation risks. So Ray Dalio, one of managing probably the largest hedge fund on earth, he said the two main risk factors for the average portfolio are less than expected growth and more than expected inflation. So let's have a look at the expectations again. We did that for our last In Gold We Trust report, so we had a look at Bloomberg. What are the most important economists actually forecasting? So 89 economists sitting at the big Wall Street banks, sitting at the big institutions, IMF, BIS, and so on. What do they see for 2017, 18, and 19? What would you say? How many do see a recession coming up? 0. They all see economic growth between 2.2 and basically 2.4%. That's a very, very strong consensus. Compare it to 2007, how many economists saw a recession coming up? High?
Lots of them.
0. 2007. Nobody. So I don't want to say that we will necessarily see a recession in the next couple of years, but we're already in a very long cycle. But if recession fears come up and everybody is on one side of the boat and everybody is positioned for basically the economy doing okay the next couple of years, and if recession fears should come up, this will move markets. This will have massive consequences for markets, and it would probably also lead to a U-turn of monetary policy. And I think if the Fed basically admits quantitative tightening is over, we will have to lower rates again. This is going to be the time when gold probably picks up momentum big time, when gold will be at 1,1500 within a very, very short period because the market has to readjust. What you can see here is the rate hike cycles since 1914. So it's a very, very long-term chart, and you can clearly see it's a very, the evidence is overwhelming. In the past 100 years, 16 out of 19 rate hike cycles were followed by recession. Every time we saw a financial crisis before we have seen rising rates. So my thesis is basically the financial tightening already started in 2013 when Ben Bernanke announced tapering. Since then, we've seen some sort of a tightening of monetary policy. So I think the odds are pretty high that a recession might be upon us sooner or later because we are in this rate hike cycle, and as always, central banks are way behind the curve. We just put out the chart book, an update of our gold report, but we also did a couple of charts about recession fears coming up. So we basically got consumer credit being very, very sluggish. We've got credit growth in general pretty weak. And what you can see here is gross tax receipts. And it also works for corporate taxes. It's massively diverging from the S&P. And normally there's a very, very tight correlation. So if the US economy is actually doing really so well, why are the gross tax receipts going lower? We'll see. Now, what does it have to do with gold? Why is a recession actually important for gold? We crunched the numbers and we had a look at the performance of gold in recessions. And actually, recessions are a very, very positive environment for gold. The mean is 20.8%. So gold within the environment of a US recession is up 20.8%. That's a pretty decent performance. Why? Because gold anticipates that politicians and central bankers will add fiscal stimulus, will lower rates, will do quantitative easing or whatever. And therefore, recessions are an excellent environment for gold. And the second trigger might be inflation risks. At the moment, nobody really cares about price inflation. As I've said, first I see monetary inflation, then asset price inflation. We're having massive asset price inflation at the moment. So the third stage normally is price inflation. Now, politicians and central bankers are desperate in creating higher price inflation. It really worries them that the decrease in purchasing power is not big enough, which is kind of weird from my point of view. So we don't care about those official numbers like the PCE or the CPI. We know how those numbers are calculated, so we are calculating our own inflation indicator. And actually, it did pretty well. So those are rising inflation times. It correlates pretty well with inflation-sensitive assets. Unfortunately, since we launched our fund, we've got mostly falling inflation rates, but due to the signal, we only had a small drawdown, like 8% in our fund, which was really, really good. But now, since end of September, we've got a rising inflation signal again. And people often say they don't see inflation coming up. From my point of view, wages, especially for skilled workers, might be a reason for higher price inflation. Of course, also energy. Just have a look what's happening in Saudi Arabia at the moment. And I think that inflation is something that actually, if you study history and if you study monetary history, you cannot control inflation. It's not like a thermostat. So inflation often pops out really, really massively and then gets out of control. So this is definitely something that we've got on our minds. Mining stocks, that's basically why we're all here. In my last report, I was quoting celebrities like Homer Simpson, but also Rocky Balboa. And he said, going in one more round when you don't think you can, that's what makes all the difference in your life. And this is something So Rocky Balboa wins against Ivan Drago. Everybody who knows something about boxing, he should have been dead already 3 times in this fight. And it reminds me a bit of the mining industry. Actually, the mining industry really did their homework well the last couple of years. What you can see here is the free cash flow of the companies in the Gold Bucks Index, 16 companies. And actually, the free cash flow last year was $4.8 billion US dollars, and it was higher than in 2011. In 2011, Gold Bucks Index traded at 600, now at 180, something like that. But the most important driver, of course, for free cash flow, gold, was at 1620, while now it's at 1244 on average. So from my point of view, the mining stocks really did a great job. They got leaner, they got a more solid balance sheet, they got their costs under control, they changed management, they got rid of projects. So I think the foundation or the basis of the sector is better than ever. And we should not forget, Rick Rule always says that the bear market is the foundation for the next bull market. So the last bear market in mining stocks, in gold mining stocks, measured by the Barron's Gold Mining Index, which is the longest available mining index, we've seen the longest and most severe bear market in history. So this goes back to, I think, the 1940s, 1939. The last bear market was the most brutal and the longest bear market in history. We shouldn't forget that. When do you usually buy Christmas decoration? When I met my wife, she was buying Christmas decoration in January. I said, what are you doing? I mean, Christmas is still a few months away. She said it's 50% off. It's a pretty smart move. Now, nobody's really interested in mining stocks at the moment. And many people said, okay, this was already the end of the bull market. It was just a very short party. Now, given the fact that I've shown you before that we've seen the longest bear market in history, I wouldn't think that this bull market will be the shortest in history. So actually, we're only here. We basically made 80% from the lows. Normally, the bull market should last much longer. And at the very end, there's this mania phase, this distribution phase. We're far away from that phase at the moment. So, my outlook. Gold is dirt cheap, measuring it in monetary terms. So we can basically thank central bankers making gold significantly cheaper. So the coverage ratio of the US monetary base is very close to all-time lows. My summary. The current environment, as I've said, is not really favorable for gold. Lots of headwinds, but still, gold is up 10% since the beginning of the year. If the normalization of monetary policy does not succeed, which I expect, gold will pick up momentum. Price inflation might surprise on the upside due to oil prices, political events, wage inflation. Mining stocks are in the beginning of a new bull market. We have seen creative destruction. And from my point of view, the leverage on rising gold prices is higher than ever. And we expect the gold-silver ratio to decline. Normally, in a bull market of gold, silver outperforms gold, so we're seeing a falling gold-silver ratio. Therefore, silver mining stocks that absolutely nobody cares about at the moment should be particularly interesting investment opportunities. Ladies and gentlemen, many thanks for your time and cheers. Thank you very much.
Thank you very much, Ronnie. And ladies and gentlemen, thank you so much for being here today. We hope to see you back next year in early November.